Benjamin Graham, born as Benjamin Grosbaum on May 9, 1894, in London, England, was a British-born American financial analyst, investor, and professor. He is widely recognized as the father of value investing, and has made significant contributions to the field of investment. Graham graduated from Columbia University at the age of 20 and started his career on Wall Street. He eventually founded the Graham-Newman Corp., a successful mutual fund. Despite earning approximately $500,000 per year by the age of 25, Graham lost nearly all of his earnings and investments in the stock market crash of 1929. This experience inspired him to write Security Analysis, and shaped his lifelong quest for investment values. Graham is known for his two seminal works, Security Analysis, 1934, co-written with David Dodd, and The Intelligent Investor, 1949. These texts laid the foundation for the discipline of value investing. His investment philosophy emphasized independent thinking, emotional detachment, and careful security analysis. He stressed the importance of distinguishing the price of a stock from the value of its underlying business. Today, Graham pioneered the concept of value investing, which involves buying stocks at a discount to their intrinsic value. His approach emphasized the importance of a company's fundamentals over short-term market swings. Graham was instrumental in establishing the profession of security analysis and the Chartered Financial Analyst designation. His work laid the groundwork for the in-depth fundamental valuation used in stock analysis today. Benjamin Graham managed risk through a number of key strategies. 1. Investing with a margin of safety. This principle involves buying a security at a significant discount to its intrinsic value. The goal was to buy assets worth $1 for 50 cents. This approach not only provided high return opportunities but also minimized the downside risk of an investment. 2. Understanding market volatility. Graham viewed market volatility as a given, but also as an opportunity to buy stocks at a discount and sell at a premium. 3. Diversification. Graham recommended distributing one's portfolio evenly between stocks and bonds as a way to preserve capital in market downturns while still achieving growth of capital through bond income. 4. Understanding investor psychology. Graham cautioned his readers to understand what kind of investor they are, active versus passive, before they become involved with the market. 5. Focus on fundamentals. By pinpointing companies with robust fundamentals at bargain prices, he aimed to minimize the risk of permanent capital loss while maximizing the potential for juicy returns. 6. Long-term profitability. Graham's approach focused on a margin of safety, minimizing risk while seeking long-term profitability. These strategies helped Graham manage risk effectively and are still widely used by value investors today. Graham also held an adjunct teaching position at Columbia University. One of his most notable students was Warren Buffett. Warren Buffett had a profound relationship with Benjamin Graham, who was not only his mentor but also his employer and friend. Buffett studied under Graham at Columbia University and was deeply influenced by Graham's investment philosophy. Buffett spent his late teens consuming as many books on stocks and investing as possible. When he picked up a copy of Benjamin Graham's book, The Intelligent Investor, in 1949, his life was changed. For Buffett, it was almost like he found a god. He was accepted into Columbia Business School, and in the spring of 1951, he had the privilege of taking Graham's class. Buffett learned three main principles from Graham that established the foundation of his investing approach. 1. A stock is the right to own a little piece of a business. It can be easy to get caught up in a volatile stock's performance and forget that it represents ownership of a company. In the long term, a stock is only as valuable as its company. 2. Use a margin of safety. A fundamental aspect of value investing is using a margin of safety, which calls for purchasing securities when their market price is significantly below their intrinsic value. 3. Mr. Market is your servant, not your master. Graham used Mr. Market, a moody and easily excitable character, to personify the stock market. Buffett approached Graham for a job in his investment firm. Initially, Graham declined, but Buffett was persistent, and Graham finally yielded, giving Buffett a job in the firm. This was the start Buffett needed, and he has never failed to acknowledge what he learned from Ben Graham. To this day, Buffett, once the richest man in the world, calls Graham's book, The Intelligent Investor, the best book about investing ever written. Graham's influence extends beyond his lifetime, with many successful investors, including Irving Kahn, Charles D. Ellis, Mario Gabelli, Seth Klarman, Howard Marks, John Neff, and Sir John Templeton, citing his teachings as a significant influence on their investment strategies. Benjamin Graham passed away on September 21, 1976, in Aix-en-Provence, France. He was 82 years old at the time of his death. The cause of his death is not specified in the sources I found.